Be Wealthy and Smart, episode 1622.
Step into a world of wealth and financial freedom without budgets, boredom, or bosses on Be Wealthy and Smart. And now, here's your host, Linda P. Jones.
Welcome to Be Wealthy and Smart. I'm Linda P. Jones, America's Wealth Mentor, empowering women and men worldwide to financial freedom. On today's show, we're going to talk about what is a K-shaped economy. This is something that's actually about the gap between the best and worst off Americans and how it's growing. Apparently, part of it happened during the pandemic when Americans' financial habits changed about 6 years ago. Economists now warn that this two-speed economic structure is a core feature rather than a passing fad within the world's largest economy. The upper part of the K refers to higher income Americans seeing their incomes and wealth rise, while the bottom part points to lower income households struggling with weaker income gains and steep prices. A big reason the term is popping up so often is that it helps explain an unusually muddy and convoluted period for the U.S. economy. Growth appears solid, yet hiring is sluggish, and the unemployment rate has ticked up. Overall, consumer spending is still rising, but Americans are less confident, and AI-related data center construction is soaring while factories are laying off workers and home sales are weak. The stock market still hovers near record highs even as wage growth is slowing. It also captures ongoing concerns about affordability, which is much more of a concern for middle and lower income households. Persistent inflation has received renewed political attention after voter anger over costly rents, groceries, and imported goods has impacted political opinions. Peter Atwater, an economics professor at William and Mary in Virginia, said, "Those at the bottom are living with the cumulative impacts of price inflation. At the same time, those at the top are benefiting from the cumulative impact of asset inflation." Atwater actually popularized the label K-shaped economy during the pandemic after seeing it crop up on social media. Other economists were discussing different letters to describe how the COVID recession in 2020 could play out. Would it be a V-shaped recovery, meaning a sharp decline and then a rapid bounce back? Or would it be a U-shaped, meaning a more gradual rebound? Or worse, L-shaped, a recession followed by extended stagnation? Atwater said there was sort of this land grab for letters. To me, the letter that made the most sense was K. Back then, it captured the differing fortunes between white-collar professionals still employed and working at home while stock prices rose, even as massive layoffs at factories, restaurants, and entertainment venues pushed unemployment to nearly 15%. Inequality was somewhat reversed in the aftermath of the pandemic when businesses offered large raises for blue-collar workers as the economy reopened and demand surged. Many companies, restaurants, hotels, entertainment venues, were caught short-staffed and sought to rapidly increase hiring. Lower-income workers saw larger pay gains than higher-paid ones. In 2023 and 4, inflation-adjusted wages for the bottom quarter of workers rose at a yearly rate of 3.9%, outpacing the 3.1% gains for the top quarter, according to research by the Federal Reserve Bank of Minneapolis. This year, however, inflation-adjusted wage growth has weakened as hiring has fallen, with the drop more pronounced for lower-income Americans. Their wage growth has plunged to an annual rate of just 1.5%, the Minneapolis Fed found, below that of the highest earning quarter of workers at 2.4%. Slower income growth has left many lower-income workers less able to spend. Based on data from its credit card and debit card customers, the Bank of America Institute found that spending among higher-income households rose 2.7% in October, compared with a year ago, while lower-income groups lagged at just 0.7%. And a Federal Reserve Bank of Boston study in August found that consumer spending in recent years has been driven by richer households, while lower and middle-income Americans have piled up more credit card debt even as they've spent less. A key measure of wealth concentration called the Gini, G-I-N-I, coefficient sits at 60-year highs, according to a report from U.S. Bank published earlier this month. That signaled a reversal of the drop to multi-decade lows seen amid the rollout of pandemic-era economic stimulus, said Beth Ann Bovino, the bank's chief economist. The net worth of America's top 1% hit a record share of nearly 32% in the third quarter of 2025, the Federal Reserve reported. By comparison, the bottom 50% cumulatively held 2.5% of overall net wealth. The portion of U.S. GDP heading to workers in the form of compensation tumbled to its lowest level in its more than 75-year history, per data tracked by the Bureau of Labor Statistics. That means the average non-farm business worker is seeing an increasingly small slice of an economy that has largely boomed over the last 15 years. This disparity has implications for how and if consumers spend their money. For instance, this divergence can explain why airlines are racing to build out luxury offerings at the same time that fast food companies are leaning on value meals. Households with incomes under $75,000 are allocating less on discretionary categories like travel and experiences than in 2019, while those above $150,000 are allocating more, according to a Bank of America report released last month. Total relative outlays, a broad measure of spending and non-mortgage payments by U.S. consumers in the top 20%, hit multi-decade highs last year. A data analysis conducted by Moody's found the other 80% tumbled to new lows, the data shows. For that 80%, overall spending hasn't outpaced inflation over the last 6 years, said Moody's Mark Zandi. That means neither economic quality of life nor spending power has improved for the lion's share of U.S. taxpayers in this time frame. Their standard of living has not budged since the pandemic hit, he said. It's just disconcerting. The massive investment in data centers and computing power has also contributed to the K-shaped economy by lifting share prices for the so-called Magnificent Seven companies competing to build out AI infrastructure. Yet so far it's not creating many jobs or lifting incomes for those who don't own stocks. Driven by big gains for companies like Google, Amazon, Nvidia, and Microsoft, the stock market has risen nearly 15% last year, but the wealthiest 10% of Americans own roughly 87% of the stock market, according to Federal Reserve data. The poorest 50% own just 1.1%. Many economists worry that an economy propelled mostly by the wealthiest isn't sustainable. Perkins notes that should layoffs worsen and unemployment rise, middle and lower income Americans could pull back sharply on spending. Revenue for companies like Apple and Amazon would fall. Advertising revenue, which is fueling companies such as Google and Facebook parent Meta, typically plunges in downturns. Such a cycle could even force the Mag 7 to pull back on their AI investments and send the economy into recession. So we're really seeing the wealth gap be impacted by inflation and economic trends, but we're also seeing it where the wealthiest are benefiting the most from their investments. And that's where it's important to turn income into assets to generate more wealth. And that's exactly what the K economy has proven here. If you haven't yet subscribed to Be Wealthy and Smart, hit the subscribe button and you'll be notified as soon as new podcasts are available. And all of my podcasts are on my website at lindapjones.com/podcasts. And while you're there, sign up for my weekly newsletter for more wealth tips for your financial freedom. That's all for today. Until next time, live the good life and be wealthy and smart.
Thank you for listening to Be Wealthy and Smart with Linda P. Jones. Share the wealth and tell your family and friends about the show. Check out our website, blog, and social media for more riches at www.bewealthyandsmart.com.